Hello everyone, good afternoon everyone. My name is Chirag Bhogesara and my topic presentation is Fundamental Technicals for Financial Decision Making. And today we will continue for my second session for my presentation. Last session we have got all this topic, and today we are going to cover my second session will be most on measuring on technical analysis. So we will start from the first topic from today's sessions will be technical tools and indicators, a deep dive. Technical analysis is a crucial discipline in financials that involves studying past market data, primarily price and volume to forecast future price movements. The foundational elements of the discipline are technical tools and indicators, which serves as lenses to interpret complex market dynamics and helps traders to make informed decisions. This section introduces the core concept of technical analysis and sets the stage for exploring specific tools. What are technical tools and indicators? Technical tools are charting elements like trend lines, supports, resistance levels, and indicators are mathematical calculations based on price, chart patterns, volume, or both. They aim to reveal market trends by smoothing out price data and highlighting underlying patterns. Indicators helps identify whether a market is an uptrend, downtrend, or sideways momentum, which helps the trader to make the decision according to the technical indicators. Indicators like relative strength in the RSI, boiler bands provide insight into the speed and strength of price changes as well as how much price are fluctuating. Generate trading signals. Many indicators are designed to produce clear buy or sell signals, often through crossover, divergence, or specific threshold breaches. Why they matters? In a dynamic financial landscape, technical tools and indicators are indecent because they provide a structured approach to the market analysis, moving beyond mere speculations. They enable traders to react quickly to market shifts, identify potential opportunities or risk. They form the basis for various trading strategies from short-term scalping to long-term trend following. They help unlock deeper insights into price momentums that might not be apparent from raw price charts. For best practices for technical tools and indicators, a holistic view always use multiple indicators in conjunction, as no signals indicator provides a complete picture. Confirm signals across different tools. Context is a king. Interpret indicators within the broader market context, including economic news, industries, developments, and overall market sentiments. Adaptability, different market conditions, trending, range bound, volatile, may favor different types of indicators. Be be prepared, adjust your tool set according to the assets like gold, cryptocurrency, stocks, indexes. For an analogy view, think of a technical indicators as the instrument, as in an airplane cockpit. Each instrument provides specific data about the plane condition, altitude, speed, direction. A pilot doesn't rely on just one gauge. This information from all our instruments make safe, effective flying decisions. Same as technical indicators helps to decide whether the speed of volume, chart patterns, like that. For a point of view application examples, a trader might use a moving average to confirm trends, direction, and then use then RSI to identify overbought conditions for a potential short entry. During periods of low volatility, boiler band squeeze, signaling an independent breakout, which a trader could then confirm with the increased volume. I will now proceed with the next slide, which is about RSI, which is an indicator, which is relative strength index. The relative strength index RSI is a powerful and widely used momentum oscillating technical analysis developed by J.W. Wilder Jr. Its primary function to measure the speed and the change of price momentums, providing insight into the strengths of a trend and identifying the potential overbought or oversold condition. RSI oscillates between 0 to 100, typically using a 14 period settings. For example, 14 days on a daily chart. From the example of an image, it shows the how RSI works. Measures price momentum, quantifies speeds and changes. RSI calculates the ratio of average gains to average losses over a specific period. A higher RSI indicates that the average gains are outperforming average losses, suggesting strong upward movement. Conversely, a lower RSI indicates stronger downward movement. RSI is trend by observing the movement of the RSI line, which is shown in the image, which is signal overbought or oversold. Observing the movement of other RSI line, traders can interpret the underlying strength of the current price trend. Strong trends often you see RSI constantly above, staying above 50 for upper trends or below 50 for downtrends, as per the traders. And RSI helps us to identify reversal zones. Overbought condition, if suppose it is most useful that above 70, when RSI crosses above 70 or 80, it's some aggressive settings. It indicates that the asset price has risen too quickly and made due to for a correction or pullback. This suggests a potential exhaustion of buying pressure. When it is oversold condition, it's below 30. When RSI falls below 30 or 20, it suggests that the asset price has fallen too quickly and may be due for a bounce or rally. This implies a potential exhaustion of selling pressure, suggests potential reversal while overbought or oversold signals don't guarantee a reversal. They highlight areas where the current trend might be losing steam, promoting traders to look for additional confirmations for a potential trend change. Why it is measured? RSI is crucial for traders because it provides early warning signs of potential trend executions before significant price reversal occur, helps confirm trend and identifies idle entry exit positions points when combined with the other indicators. Is versatile, can be applied to various time frames from intraday to long-term charts. For RSI best practice for divergence analysis, look for divergence between RSI and the price. If a price make a new high but RSI makes a lower high, is a bearish movement. It can signify impending reversal. Similarly, a bullish pattern or momentum, price new low, RSI higher low, suggests a potential upturn. And second, the trend confirmation. Use RSI to confirm the direction of the trend established by other tools like moving averages, which I covered in the last sessions. In an uptrend, RSI typically stays above 50, and in a downtrend, it stays below 50. Avoid blind signal. Do not trade slowly based on overbought, oversold signals, especially in strong trending markets where SI can remain in extreme zones. For extended periods, always seek confirmation price action or other indicators. From an analogy view, imagine RSI is a car speedometer for the market. When the speedometer RSI goes too high above 70, it's like the car is going too fast and might be need to slow down pull back. When it's too low below 30, the car is going to slow and might be able to speed up bounce. For application point of view example, a trader might consider selling a stock when its price near resistance and the RSI is above 70 and showing bearish divergence. In an existing uptrend, a pullback to a support level combined with RSI bouncing off the 30 level oversold could be a strong signal to buy. Next, I will go to the next slide, which is MACD, moving average convergent divergence. It is a second indicator which we'll be covering. MACD is a versatile and widely used trending following momentum indicator developed by Garrett Appel. It reveals the relation between two moving averages of an asset price, provide insights into trend strength, direction, and potential reversal. MACD is unique because it combines aspects of both trend following and momentum indicators, making it a powerful tool for various trading styles. For example, trend following momentum. MACD shows the relation between two EMAs. It reveals strength and directions. Relation between two EMAs, the core of the MACD lies in the difference between a faster exponential moving average EMA and a slower EMA. Typically, the 12th period EMA and the 26th period EMA are used with the MACD line because calculated as 12 period EMA and 26 EMA reveals trend, strength, and direction. As the faster EMA moves away from the slower EMA, it indicates increasing momentum. In the direction of the price momentum, a rising MACD line suggests standing bullish momentum, while a falling MACD line indicates growing bearish movements. When the MACD line is above zero, it generally signals an uptrend and below zero suggests a downtrend. Downtrend. Second is a crossover signals. Signal line crossover. A 9 period, 12 day and 26 day EMA relation is plotted. When the MACD line cross above its signal line, it suggests a potential upward movement shift and is often interpreted as a buy signal. When it is a bearish crossover, a sell signal will be indicated by the traders, which is used mostly. Conversely, when the MACD line crosses below its significant signal line, it indicates a potential downward movement shift and it's often interpreted as a sell signal. Zero line crossover of the MACD line or the MACD histogram across the zero line can also indicate trend changes. Above zero suggests bullish momentum, below zero suggests bearish momentum. And why it is matter? MACD is critical for traders as it official clear visual buy and sell signals through its crossovers, helps identify the start and the end of trends, making it effective of trend following strategies, can signal potential trend reversal through divergence because before price actions clearly shows them. It is a histogram that difference between the MACD line and signal line provides a visual representation of momentum expanding or contracting as the trend strengthens or weakens. For the best practices combined with price action always confirm MACD signals. Signals with price action a bullish crossover and MACD is stronger. If the price is lower, also bouncing off a support level or forming a higher lows, looks for divergence. A powerful signal is divergence between a price and MNCD. If price makes a new high but MNCD makes a lower high, bearish divergence, it can precede a price reversal. A bullish divergence, price new low, MNCD higher low, can signal a upcoming rally. Context use is strongly trending markets. MACD can stay extended for long periods. In range bound markets, it might generate more false signals. Adjust your interpretation based on market conditions. Second is the volume confirmation MNCD crossover with volume. Strong volume on a bullish crossover add conviction to the signal. From a point of view of analogy, think of a MNCD as a two ships, the EMS sailing in the ocean. When the faster ship pulls away from the slower ship, it indicates strong momentum in that direction. The signal line is like a smaller, faster boats that tells you when the main signals are changing their relative speeds, signaling a potential change in the fleet's directions. From an application of examples, a swing trader might enter a long positions when the MNCD line crosses above its signal line, while the stock price is above its 200-day moving averages, confirming a uptrend. During a during a downtrend, if the MNCD line shows a bullish divergence, making higher lows while price makes lower lows. It could indicate a potential bottom and a buying opportunity, especially near a significant support zone. And then the next slide is about Bollinger Bands. It is another indicator. Bollinger Bands are highly popular volatility indicator developed by John Bollinger. It's they provide a dynamic framework for understanding and price action relative to its typical range, offering insights into markets, volatility, potential overbought, oversold conditions, and in independent trend changes. Bollinger Band consists of three lines plotted just as the image showing 20 period SMA, lower SMA and 3 is like moving as a channel. Bollinger Band consists of three lines plotted on the price chart as shown in the picture, a simple moving average SMA and two standard deviation lines, one above and one below the SMA. It measures volatility measurement, indicate market volatility. The width between the upper and the lower bands directly reflects market volatility. When the bands widen, it signifies increased volatility, larger price swings. When the narrow, it indicates decreasing volatility, smaller price swings, often preceding significant prices moves. Help identify potential breakout points. A period of low volatility where the boiler bands contract into squeeze often precedes a strong breakout or a breakdown in price. This squeeze suggests that energy is building up in the market, ready for deceive moves. Second is the SMA and deviations, consist of simple moving averages. The middle band is typically 20 period simple moving average of the closing price. The SMA act as the central point or a baseline for the price. Two standard deviation lines surround the SMA, which are shown in the pictures. Which ones are the blue ones? Red line is a 20 period SMA. The upper band is typically set two standard deviations above the SMA, and the lower band is two standard deviation below the SMA. Standard deviation is a statistical measure of dispersion, meaning how much the price tends to vary from its averages. These bands dynamically adjust to market condition. They move further away from the SMA. The volatility increases and closer when the volatility decreases. And third, the Bollinger Band provides a signal generation. Price touching upper or lower bands signals potential reversals. When the price consistently touches or moves outside the upper band, it suggests overbought conditions and potential for a pullback or reversal to the downside. Conversely, when the price touches or moves outside the lower band, it suggests oversold conditions and potential for a bounce or reversal to the upside. However, in strong trend, price can walk the band or extend the periods. Squeezes suggest upcoming volatility as a mentioned as Bollinger squeezes occurs when the band narrows significantly that indicates price momentum or breakout. The traders watch for direction for a subsequent breakout to confirm the new trend. Breakout from squeeze, a breakout above the upper band after a squeeze often signals the start of an uptrend, while a breakdown below the lower band after a squeeze can signal the start of a downtrend. Why they matter? Bolling bands are crucial for traders because they provide a visual representation of price, volatility, and its extremes, help identify whether a price is relative high or low on a comparative basis, are excellent for identify potential turning points and trend intention signals, can be used across various markets like for stock market, forex, commodities, and different time frames occur in the traders bid for long term, short terms. As per the traders, for best practices uses, do not use in isolation. Always combine bowling bands with other technical indicators such as momentum oscillators, RSI, MACD, or volume indicators for confirmations. Contextual interpretation is a strong uptrend. Price might consistently hug or walk along with the upper band. This is not necessarily as a sell signal, but rather a sign of a strong bullish momentum. The opposite is true for downtrends. Focus on squeezes and breakouts. The most actionable signals often come after a prolonged squeeze, indicating that a significant move in implement. It looks like a W and M patterns. Look for specific price patterns with the brands such as W bottoms, which we covered in the last sessions, head and shoulder. So here are the two patterns which we have followed. W and M patterns look for specific near the lowest bell, bullish reversal and M tops near the upper band. From a point of view of analogy, think a boiler bends as a flexible river bank. When the river price, for example, is calm, the bands are closer together. When the river gets high, the volatility, the banks expanded. If the river hits one bank and stay there, it means the current is very strong and in direction. A tightening of the bank suggests the river is about to burst or bank in one direction or another. From a point of view of application examples, a trader might initiate a long position whether the price breaks above upper volume of brands after a squeeze confirming strong bullish momentum, especially accompanied by high volumes. In a sideway market, a trader would sell when the price touches the upper band and buy when it touches the lower band, assuming a reversion to the mean. Now we'll proceed with the next slide, which is stochastic oscillators. These indicators developed by George C. Lane. It is a momentum indicator that compares a particular closing price of an asset to its price range over a certain period. Its fundamental premise is that an uptrend prices tend to close near their high and their low. In a downtrend prices tend to clear near high, their low. By measuring the location of the closing price relative to its high-low range, the indicator helps identify overbought and oversold condition and crucially predicts the potential trend reversals. The first one is price range comparison. Compares a closing price to its range. The indicator typically calculate two lines. First one is the K line. The line is a primary line calculated as a percentage K. Highest low minus lowest low. Closing price minus lowest low into 100. Done for a and predicts 10 reversals. Helps predicting future trend reversals like RSI. These indicators identify overbought and oversold zones, typically above 80 and 20, below respectively. Overbought is about above 80 when the both K and D lines are above 80. It indicates that the price is closing near the top of its recent range, suggesting a potential for a downward direction. When it is oversold, it's below 20. When both A and D lines are below 20, it indicates that the price is closing near the bottom of its recent range, suggesting a potential for an upward bounce or upward trend. And looking for a divergence between price and oscillators, this is one of the most powerful signals from the stochastic oscillators. Bearish diversion if the price makes a new high, but the indicator makes a lower high, it signals weakening movement and a potential bearish reversal. When there's a bullish diversion, if the price makes a new low, but the indicator makes a higher low, it signals standing the bullish momentum and a potential bullish reversal. Crossovers between the K and the D lines also generate signals. Bullish crossover K crossing above D can be a buy signal. When a bearish crossover, when K crosses below D, its signal can be a sell signal. Best in range mode markets. This indicator performs best in sideway markets, unlike trend following indicators. The indicator tends to be particularly effective in markets that are consolidating or moving sideways within a defined range. In such markets, prices frequently oscillate between overbought and oversold levels, making a reversal signals if market them moving sideways within a defined range. In such market, prices frequently oscillate between reversal signals and more reliable confirm overboughts or oversold levels effectively. It is design which focuses on the close relative to the range, makes it excellent for identifying when a price moves has stretched too far within a limited range. So why it is matters? This indicates a visual for traders because it provides a early indication of potential trend changes, especially through divergence. Is highly effectively in identifying turning points in non-trending or range-bound markets, offer clear entry and exit signals through its overbought and oversold levels and line crossovers with the D and K lines. For best practices, confirmation is the key. Never trade slowly based on this indicator overbought and oversold signals by a trader, especially in strong trending markets where the indicator can stay in extreme zones. Always confirm with the price action, candlestick patterns, or other indicators. Focus on divergence. Divergence are often stronger signals than simple overbought and oversold readings. And we can do the adjust settings while 14 period is a common traders can adjust the periods to K and D lines and smoothing to it suit different time frames and trading styles. Shorter period makes it more sensitive. Longer period makes it more smoother. Combined with trend filter uses a long-term moving averages to determine the overall trend. Only take bullish strategy signals in uptrend and bearish signals in downtrend ignoring counter trend signals. From a point of view of analogy, imagine a driver in a swimming pool. The indicator measures how deep the driver is closing. For example, closing price relative to the top and the bottom of the pool, highest high and the lowest low of the pool of the period. If the driver is consistently hitting the bottom of the pool, it is means it's oversold. But then making higher jumps, it like a bullish divergence, showing strength even what appearing low. From a point of view of application example, a trader looking for a short-term bounce in a range-bound stock might buy when the stock indicator drops below 20 and the K line crosses above the D line. It is a short-term range. If the stock price is making new highs but the indicator is falling to make new highs, it's a bearish divergence. A trader might look for a potential short entry, especially if a price encounters a resistance level. And next we will proceed for the next slide is about Fibonacci retracement is another indicator. Fibonacci retracement is a popular technical analysis tool based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. For example, 0, 1, 1, 2, 3, 5, 8, 13. When applied to a financial market, specific ratios derived from these sequence are used to identify potential support and resistance levels where a price retracement, for example, temporary reversal against the prevailing trend might end before the original trends resumes. First one is a key ratios based on mathematical ratios. The most commonly used Fibonacci retracement levels are 38.2%, 50%, and 61.8%. Other less common but sometimes observed less include 23.6% and 78.6. These percentages are derived from the mathematical relationships within the Fibonacci sequence. For example, 38.2 is example 8 divided by 21. For example, for 61.8%, example is 8 divided by 13. also known as the golden ratio for the Fibonacci tool. For 50%, through not a direct Fibonacci ratio, it is widely accepted as a significant psychological level where prices often retrace. It is derived from the Fibonacci sequence. This ratio suggests a natural harmony and proportion found in many natural phenomena, and by extensions are believed to influence human psychology in financial markets, leading to price reactions at the specific levels. And second is identifies pullback levels used to find potential supports or resistance levels to apply Fibonacci retracement. As a trader identifies two significant price points, a swing high and a swing low, or vice versa. For an uptrend, the tool is drawn from the swing low to swing high. The retracement level 38.2%, 50%, 61.8%. Below the higher act as a potential support level where price might be bounced before the continuing its upward trajectory. For a downward trend, the tool is drawn from the swing high to the swing low. The retracement levels below the low act as a potential resistance and levels where a might reverse before continuing to its downward momentum. Third one is a combine for strength. Works well when combined with other indicators while powerful Fibonacci retracement is the most effective when used in conjunction with other technical analysis tool for confirmations. Uses it with support and resistance zone for confirmation. If a Fibonacci retracement level aligns with previously established horizontal support resistance level or a trend line or a moving average, the strength and the reliability of that level as a potential turning point are significantly enhanced. This confluence of signals provides a higher conviction for trading decisions. So, why it is matters? Fibonacci retracement is a crucial role for trader because it provides objective, predefined levels where price might find support or resistance, helps in setting entries point. For example, buying at 61.8% retracement is an uptrend and exit point for a trader. For example, taking profit if a price fails to break a 38.2% retracement level in a downtrend is a forward-looking tool offering potential future prices, targets, and reversal zones. For best practices, accurate swing points, the effectiveness of Fibonacci retracement heavily relies on correctly identifying the significant swing high and swing low from which to draw the levels. Not a guarantee, but Fibonacci levels are not exact turning points, but rather zones of interest. Price may overshoot or undershoot these levels. Multiple time frames use Fibonacci retracement on a higher time frame, example daily or weekly time frame for stronger levels. Then refine entries on the lower time frames. Fibonacci extensions beyond retracement Fibonacci extensions, example 127.2%, 161.8%, can be used to project potential price targets on a retracement is complete and the original trend resumes. On a analogy point of view, think of a Fibonacci retracement as a rubber band. When you stretch the rubber band and then release it, tends to snap back to certain predictable points. The Fibonacci levels before potential stretching again into the original direction. These snapback points are where the market pauses and potentially reverses. For a application example, it is in a strong upward trend. A trader might wait for the price to pull back to the 61.8% Fibonacci retracement level, especially if that level considers with the major moving averages to initiate a long position. After a significant drop, if a stock rallies and then hits resistance at the 38.2% Fibonacci retracement level, a bearish trader might consider a short entry, anticipating a continuation of the downtrend. Now proceed with the next slide. which is about moving averages, SMA versus EMA. SMA is simple moving average, EMA is a exponential moving average. Moving average are one of the most foundation foundational tools in technical analysis. They help traders smooth out price data, filter market noise, and identify the direction and strength of a trend. By providing a continuously updated average price over a specific period, they offer a clear picture of an asset price action. Then raw fluctuating prices. There are two primary types of moving averages used by a trader: the simple moving averages and the exponential moving averages, which is SMA and EMA. First one is a simple moving average. This is the arithmetic mean of a security price of or a given number of periods. For example, calculation example of 50-day SMA adds the last 50-day closing price and then divides by 50. Each new day, the oldest price drops out and the new price is added. So for a smoother lines, by giving a equal weight to all data points, it creates a very smooth line, which is excellent for identifying clear long-term trend direction. For long-term trend direction, it is a lagging nature, means it filters out a short-term price fluctuation, making it ideal for understanding the broader market basis. And the slower to react to sudden prices changes because it treats all last prices equally. It reacts more slowly to recent price shifts or sudden changes in the market sentiment. These lag can use delayed signals. And the second one is EMA, exponential moving average, gives more weight to recent price, making it more responsive to current market conditions. For calculate example, a 21-day EMA calculates a weighted average where the most recent closing price have a greater impact of the average than older prices. This weighing factor makes it more sensitive. So 20-day one is a great for short-term trading and capturing momentum shift. It responsive means it turns more quickly in response to recent price changes, making it better for identifying short-term trends and capturing momentum plays. Timely signal EMAs can provide earlier signal for potential trend changes compared to SMAs of the same period. Sometimes EMA can give false signals in the choppy or sideways markets. It is sensitive can lead to more false signals in a volatile or non-trending markets as it reacts to every minor price fluctuations. So why it is matters? Moving averages are indispensable because they act like a dynamic support and resistance zones. Price often find support at moving averages in an uptrend and resistance at moving averages in a downtrend, helping traders determine whether to go long or short based on trend direction. If prices is consistently above moving averages suggest an upward, go long. If consistently below a downtrend, go short. Common crossover strategies are built using two moving averages, short term versus long term. This intersection of a fast MA moving averages, shorter period, and a slow MA longer period generates a powerful trade signals. Golden cross key strategy using MSA. There are some key strategies using these indicators by moving averages. First one is golden cross occurs when a shorter term moving average, example 50 SMA, crosses above the long-term moving averages, example of 200 SMA. This widely watched bullish trend confirmation signal suggesting a strong upward trend is establishing. Second is the death cross occurs when the short-term moving averages, example 50 SMA, crosses below long-term moving averages, example 200 SMA. This is a widely watched bearish trend confirmation signal suggesting a significant downtrend is forming. For real life example in 221, HDFC Bank E9 EMA crossed above its 21 EMA on the daily chart while the price was bouncing off a key support. This signal proceeded 10% rally over the next 3 weeks. Many technical traders use this crossover method with success as it provides an early momentum shifts. For best practice, you use longer MA, moving averages like 200 to 100 to understand the overall market trend. This provides the big picture and filter out minor noises. Use shorter EMAs like 9 and 21 for entries and exit. Their responsive makes them suitable for timing trade entries and managing positions. Always confirm AMA moving averages crossover with volume and momentum indicators. For example, RSI, MACD. Strong volume on a crossover adds a conviction to the signals. Momentum indicators can confirm the strength of the amount. For my application example, in a confirmed uptrend price about 200 SMA, traders often buy when the price bounces off the 21 EMA, using it as dynamic support. In downtime, moving averages often act as a resistance. For example, if a stock is in a downtrend, price might rally to touch the 50 EMA and get rejected, signaling to a continuation of the sell-off. And the next slide is trend lines and channels divided into three: defined trend direction, reversal signals, and volume confirmations. The next slide is this slide is about talking about trend lines and channels. First one, define trend directions. Trend lines and channels are fundamental graphical tools in a technical analysis that provides a visual representation of a price trends. They help traders identify the direction, strength, and potential duration of a price momentum, offering a clear boundaries within which price is expected to move. These tools simplify complex price action, making it easier to spot trading opportunities and potential reversal. And the first one is define trend direction, line connecting highs or low defined trends. First one is uptrend line. So if you can see here the down channels, up channels, sideways channels. The first one is uptrend channel or a line, you can call it line or channel, drawn by connecting two or more successive higher lows. This line acts as a dynamic support level, indicating that buyers are stepping in it progressive higher prices. On the second downtrend channel or line, drawn by connecting two or more successive lower highs. These lines act as a dynamic resistance levels, indicating that sellers are stepping in at progressive lower prices. And the third one is a sideways trend or consolidation. In a sideways markets, trend lines can be drawn horizontally to connect approximate high and lows, forming a range between. Seen in the pictures, there are shown. The first one is downtrend channel, which is going downwards. Upward channels will going making higher and higher. In sideways ranges, it shows the sideways channels. The patterns are bar candlesticks are roaming in the same range. Provide visual context for price action, trend lines, and channels offer an immediate visual cue about prevailing market sentiment. They help filter out the noise of a minor price fluctuation and focus on forward direction. The steeper the trend line, the stronger the underlying momentum. And the second one is a reversal signals. A break of a trend line often signals a reversal. One of the most important signals from trend line occurs when the price breaks diversely through an established trend line. Uptrend line break, a break below an uptrend line suggests that buying pressure is weakening and a potential trend reversal to the downside, or at least a strong correction might be underway. For a downtrend line break, a break above a downtrend line suggests that selling a pressure is easing and a potential trend reversal to the upside and could be starting. This indicates a shift in market sentiment. A trend line break signifies that the previous balance of a power between buyer and seller has shifted, leading to a change in dominant market direction. And the third one is a volume confirmation. Third one is a volume confirmation combined with volume for stronger signals. Volume is a crucial confirming indicator for trendline breaks. Increased volume on a breakout confirms the move. If a trend line is broken with a significant increased volume, selling volume, it adds conviction to the bearish reversal signal. If a downtrend line is broken with a significantly increased buying volume, it stands the bullish reversal signal. Low volume on a break may indicate a false breakout or a less conviction reversals. And channels. Parallel trend lines. A channel is formed by drawing a line parallel to the initial trend line, uptrend or downtrend, at the approximate distance of the swings on the other side. Upward channel, a parallel line drawn along the highs in the uptrend. Downward channel, parallel line drawn along through a low in a downtrend, forming a channel. Why they matters? Trend lines and channels are initial because they are simple are yet powerful visual tools that are easy to draw and understand, clearly define the boundaries of a price momentum and show where potential support and resistance lie, help identify potential entry points, stop loss levels, and profit targets, are effective across all time frames and asset classes. Best practices for connect at least 2 points, preferably three. Valid trend lines should connect at least two significant swing points. Three or more points can the make the tone more reliable. Adjust and redraw trend lines are can dynamic as a price action evolve. You may need to adjust your redraw your trend lines to accurately reflect the current trend line. From a point of view of analogy, imagine a ball bouncing down a staircase. The handrail represents the downtrend line guiding a descent. If the ball suddenly bounces over the handrail, it's like a trend line break, suggesting a change in direction or that is no longer following the same path. A channel is like a specific lane on a highway, keeping traffic with boundaries. For a point of view for application example, a trader might initiate a long position when price is bouncing offer a confirmed uptrend line that has held multiple times, especially if combined with a bullish candlestick pattern. If a stock is in a strong downtrend within a channel, a trader might look for a short opportunity when the price is hit the upper boundary of the channel resistance and they break below the lower boundary for confirmation or confirmed downtrend. We will proceed for the next slide. Next slide is about the charting platforms, which is all over famous in India. Charting are initial tools for technical analysts and traders, providing the visual interface to display price data, apply technical indicators, and execute trades. This platform ranges from basic indicator tools provided by brokers to advanced feature-rich standalone applications. Selecting the right charting platform is crucial for effective analysis and execution, catering to different trading styles and needs. Here are the key charting platforms which are shown in the pyramid. First one is a trading view, most popular, offering extensive features. TradingView is renowned for its intuitive interface, vast array of indicators, drawing tools, and social trading features. It supports multiple asset classes including stocks, forex, cryptocurrency, and commodities. Available in both free and paid versions. In a free version, offers sufficient functionality of basic analysis, while paid subscription unlock advanced features, more indicators per chart, custom timeframes, and multi-chart layouts, making it suitable for both beginners and the professional trade. Second platform is investing.com, comprehensive financial news and tools. While primarily known for financial news and market data, investing.com also offers a robust charting capabilities. It integrates real-time quotes, economic calendars, and a wide range of analytical tools. Includes robust charting capabilities. Its charts are powered by TradingView technology, offering a good selection of indicators and drawing tools, making it a reliable option for traders who also need quick access to fundamental data and news. The third one is the MetaTrader platform. Metadata platform is the industry standard for forex and commodities trading. Metadata 4, MT4 and its successor metadatas are the most widely used platforms by retail forex and commodity traders globally. They are known for their relatively powerful charting and automated trading capabilities, highly customizable and feature-rich. Metatable platforms support custom indicators, expert advisors for automated tradings, and a large community for support and resource sharing. They offer a deep level of customization for charts and trading environments. For example, exchange tool example NSE and BSE. NSE and BSE offer integrated charting tools. Many stock exchange and their associated brokerage firm provides their own integrated charting tools directly on their trading platforms. These are typically simpler than standalone platforms but are convenient for direct trade execution. Second is a cater specifically to local market. These tools are often tailored to specific local market data, regulation, and trading instruments, making them suitable for trader focused only on their domestic matches. So why they matters? Charting platforms are indispensable for technical analysis because they provide a visual representation of price, data, making patterns and trend easier to spot. Often a very array of technical indicators and drawing tools to aid in market analysis, allow backtesting strategies for a trader, and in some cases, directed executions, enable real-time market monitoring and quick decision making. For best practices for this platform, choose based on need. Select the platform that aligns with your trading style. For example, forex traders might prefer MetaTrader, while multi-asset traders might learn towards TradingView. Learn the features fully, explore and understand all the tools and functionalities offered by the chosen platform to maximize its utility. Practice is charting regularly, practice online timelines, identifying patterns, and applying indicators to develop your shading skills. From a point of view of an analogy, think of a chatting platform as a Sophisticated telescope for the financial markets, just as telescopes allow you as an astronomer to observe distant stars and celestial patterns. A charting platform allows a trader to observe price momentums, identify trends, and spot trading opportunities that are otherwise invisible to naked eye, which platform are offer different lenses and functionalities to enhance this view. From an application point of view example, a day trader might use a trading view to set up multiple charts across different time frames. For a point of view of forex trader, might develop an automated trading strategy using an expert advisor on MetaTrader, relying on a robust backtesting and execution capabilities. We will proceed to the next slide, which is about strategy building, strategy building with technical tools. Strategy building in a cornerstone of successful trading and investing. It involves systematic combining various technical tools and indicators to create a robust and repeatable framework for making trading decisions. A well-defined strategy removes emotion from trading, provides a clear entry and exit rules, and it's initial for consistent performance and effective risk management. So, what is strategy? Clearly, strategy define entry and exit point. A robust strategy must precisely outline the condition under which you will enter a trade, go long or go short, and exit a trade, take profit or cut losses as per your technical analysis. These conditions should be based on signals generated by chosen technical tools, which we discussed it by applying different indicators like RSI, EMA, MACD, boiler bands. For a for a simple example, entry rule: enter long when a 9 period EMA crosses above the 20 period EMA, and RSI is above 50, and price is above the 200 periodical SMA. For the example, exit rule: exit long when the 9 period EMA crosses below the 21 period, or when the price hits the predefined take profit level, or when the price hits the stop level. Set specific rules for trading discussions. Every discussion from position sizing by holding time should be governed by pre-established rules, not by impulse or emotions. These include rules for confirming signals, handling false breakout, and adjusting to market condition. Second point is backtesting. Test or strategy on historical data involves applying your defined strategy rules to past market data to see how it would have performed. This is a critical step to evaluate your strategy viability before taking risk real capital. Verify the effectiveness over time. Look for consistent profitability, reasonable drawdown, maximum loss for a peak from a peak, and a good win rate. Backtesting helps to identify flaws, optimizing parameters, and building confidence in our strategy. It also helps to understand the typical performance metrics of the strategy under various market conditions. Next point is set levels. Established stop loss order to limit losses. A stop loss is a crucial risk management tools. It is a predetermined price level at which a will trade will be automatically closed to prevent further losses. If the market moves against your position, defining the level as a part of a strategy. Example, a place stop loss of 180 or below entry. It is non-negotiable. Define target prices for profit taking. A target price is a predefined level where you will close a profitable trade. This can be based on Fibonacci extensions, which we discussed earlier. Previous resistance or support levels or a specific risk to reward ratio from your entry. Having a profit target helps you to lock in a gains and avoid greed. The last one is the risk management. Always adhere to a strict risk management rules. This is arguably the most important component of any trading strategy. It involves protecting your capital to all costs. Protect your capital with every trade. Positioning sizing never risk more than a small percentage, example 1 to 2% of your total capital on any signal trade. This ensures that a series of losses does not wipe out your account. Risk to reward ratio aim for strategies where the potential profit reward is significantly larger than the potential loss. For example, 1 is to 2 or 1 is to 3 risk to reward ratios. So why this is matters? Strategy building is a paramount because it provides a discipline and removes emotional decision making, which is often of the downfall of a traders. Offers a quantifiable way to assess the potential profitability and risk of your trading approach. Creates a systematic framework that can be refined and improved over time. Ensures longevity in trading by focusing on capital preservations. From a point of view of analogy, think of a trading strategy like constructing a house. You need a detailed blueprint, defined rules, strong foundation, risk management, and you must test in structure integrity by backtesting. Before you move in, trade with real money. Without a blueprint, the house will collapse. Without a strategy, your trading account like we will too. From an application example, a long-term investor might define a strategy to buy a stock when its price crosses about its 200-day SMA, and the backtest this rule over the last 10 years to its historical returns and downturns. This rule then a stop loss below the 200-day SMA and target price are based on the fundamental valuation of a stock for any company. So, the next topic is behavior finance and market psychology. So, our topic is next topic is behavior finance and market psychology. Well, traditional finance theory often assumes that investors are rational decision making who act logically to maximize their utility. Real world market frequently exhibit behaviors that defy such as assumptions. This is where behavioral finance steps in it. It is an interdisciplinary field that combines insight from psychology and economics to understand how cognitive biases, emotion, and social influences impact financial decision and market comes outcome. Understanding behavioral finance in critical for investors and analysts to gain deeper insight into why markets do not always behave logically and why seemingly rational strategies can sometimes fail. Understanding the human side of financial decision making, critical for deeper insights into market behavior. Traditional models often fall short in explaining phenomena like market bubbles, crashes, and precision mispricing. Behavioral finance provide a lens to understand the underlying human psychology drivers behind these irrational events. It acknowledges that human beings are not always economic men, making perfect or emotional calculation. explores how convective biases and emotional influence investor decision. Investor are susceptible to wide a very cognitive basis, systematic error in thinking, and emotional influences like fear and greed. These factors can lead to irrational choices such as buying high and selling at low, holding on to losing investment too long, or chasing trends without a proper analysis. So why this is matters? Behavioral finance and market psychology are crucial because they provide a comprehensive understanding of a market dynamics beyond pure quantitative analysis, helps explain market economies, bubbles, and crash that are difficult to explain with traditional theories, allow traders and investors to identify their own psychological traps and develop strategy to counteract them, enable financial professionals to better understand and advise clients, recognize their inherent biases. For best practices for this self-awareness, the first step is to recognize your own bias and emotional triggers. Second is developing rule-based strategies, counter emotional decision by strictly to predefined trading plans, entry exit criteria, and risk management rules. Stay informed but not overwhelmed. Understand market psychology but avoid getting swept away in a crowd sentiment. One application examples: an investor avoids buying into a hot stock that is surprisingly purely on hype, recognizes the potential for herd behavior, and overconfidence by driving its price beyond fundamentals. A trader set a strict stop loss on a losing trade, counteracting the sunk cost fakely might tempt them to hold in a hopes of a recovery despite deteriorating the technicals. Now we'll proceed to the next slide, which is what is a behavioral finance? Behavioral finance is an innovative field of a study that bridges gap between traditional finance theory and human psychology. It challenges the long held classical economic assumption of investors as purely rational beings who always make logical decisions based on complete information. Instead, behavioral finance systematically investigates how favorable factors, cognitive biases, emotional influences lead to systematic deviation from rationality in financial decision making. The first one is about psychology influence on investing. Behavioral finance studies how and psychology factors and impact investor decisions and financial market. This include examining phenomena like herd mentality, overconfidence, anchoring, and loss aversion, all of which are rooted in human psychology rather than strict economic logic. It delves into the internal mental process that drive individuals' financial choices. It cautions that the traditional finance assumption that investors always act rationally and have perfect information. Classical finance models often assume perfect information processing and logical utility. Maximization behavioral finance by context demonstrates that emotional responses, mental shortcuts, and systematic errors in judgment are previous. Why behavioral finance matters in financial analysis? Behavioral finance helps to explain irrational market phenomena such as bubbles, crashes, and overreaction, which classical models can fully address. The traditional models struggle to account for extended periods of asserting mispricing of sudden sharp market movements, not directly tied to fundamental news. Behavioral finance offer explanation rooted in collective physiological, like irrational exuberance during bubbles or a panic during crashes. For example, in the dot-com bubble of the late 90s, where internet stock traded an overvaluation with little underlying profit, it is a classic example of a phenomenon better explained by behavioral factors like herd mentality and overconfidence than by rational economic models. So why it is matter? Understanding what is BL finance is crucial because it provides a more realistic framework for interpreting financial markets, acknowledging human imperfections, helps individuals recognize and mitigate their own cognitive biases, leading to more disciplined investment decisions, offer valuable insight for a financial advisor to better understand and serve their clients. From a point of analogy, a traditional finance is looking like a financial spreadsheet or a price chart, assuming perfect rationality. Then a behavioral finance is like adding psychological profile of the people creating those numbers and patterns. For an application example, an analyst studying a market bubble uses behavioral finance to explain why asset price continue to rise far beyond their instinct value, attributing to it to herd behavior and irrational exuberance rather than slowly to economic fundamentals. Let's proceed to the next slide. The next topic is rational versus irrational investing. The debate between rational and irrational investing lies at the core of the different philosophies of traditional finance and behavioral finance. Understanding this distinction is fundamental to appreciating how actual market participants often deviate from textbook economic models, leading to market inefficiencies and opportunities. This ideal investor assumes make decision logically optimizing returns with clear rational analysis. Perfect perfect information in classical finance, it assumes that all relevant information is immediately and efficiently incorporated into asset prices. Investors are seen by having have access to and perfect processing this information. Utilities maximization. Investors are considered economic men, homophonics, whose sole objective is to maximize the utility satisfaction or financial gain by making perfect logical decisions. So, behavior and science. Next, second point is the behavioral finance in the real world investor. Recognize the emotions, biases, and often drive financial choices deviating from pure logic. Emotion like fear and greed. Human emotions frequently override rational thought. Fear can lead to panic selling, while greed can drive speculative bubbles, causing investor to hold on to winning a position too long or chase risky assets. Creative basis, there are systematic errors in thinking that affect decision making. Example include confirmation bias, seeking out information that confirms existing beliefs, overconfidence bias, overestimating one's abilities or the accuracy of one's forecasts. So why they matter? Understanding the distance between rational and irrational investing is crucial because it provides a more realistic lens through which to view market behavior, acknowledging the human psychology plays a significant role alongside with economic fundamentals. It helps explain market anomalies, bubbles, and crashes that are often by purely rational models. From a point of view of analogy, imagine you are trying to reach a specific destination. Classical finance assume you will always take the most direct, efficient route based on a perfect map. And preserve navigation. Behavioral finance, however, observe that you might get distracted by interesting detours, influenced by other cars' routes, herd behavior, or simply fail to acknowledge to keep driving emotion leading to the down path. From an application example, investor holding a stock that has continuously dropped and despite negative news is like exhibiting irrational behavior driven by loss aversion, and the song cost is focusly contradicting consideration. The rational decision is to sell and cut losses. During a market downturn, a rational investor might see opportunity in fundamentally sound and undervalued stocks, while an irrational investor might panic sell all their holdings due to fear and recurrency biases during locking in losses. Next to the next slide, which is about prospect theory and loss aversion. Prospect theory of is a groundbreaking psychological theory developed by Daniel Daniel Kahneman, and Amos Tversky that describes how individuals make decisions under risk and uncertainty. It stands in contrast to expected utility theory by demonstrating that people evaluate potential outcomes not in terms of absolute wealth, but rather in terms of gains and losses relative to a specific reference point. A central tenet of prospect theory and losses conversion of behavior finance in a loss aversion. The first one is the impact of loss aversion. Investors direct this opportunity feel that pain of losses more intensely than the pleasure of equivalent gains. This is the core concept of loss aversion. Research suggests that psychological pain associated with the loss is approximately 2 to 2.5 times more powerful than the pleasure derived from an equivalent. For instance, losing 100 feels much worse than gaining 100 feels good. Second is the consequences for investor behavior. These biases often leads to premature selling of a profitable asset. Disposition effect. Due to loss aversion, investors are often eager to realize small gains quickly, fearing that the profit might evaporate. They take the profit too soon to lock the positive feeling of a gain, even if the asset has either upside or potential. This effect is also known as disposition effect, and the present holding of losing positions, holding into onto losers. Investors are highly reluctant to realize these losses. They tend to hold on to losing investments for too long, hoping they will come back to even. This influence current decisions even if those investments are irrecoverable. For best practices, it set strict stop losses before entering a trade. Determine your maximum acceptable loss. Implement a stop loss order. This automates the decision to cut losses, removing emotion. Develop a profit taking strategy. Have a clear plan for taking profit. Example: trading stop loss target levels to avoid premature selling of the winners. Focus on percentage of a portfolio. Think about the percentage of a portfolio at risk or gain rather than absolute dollar amount to help manage emotional responses. Reframe losses. View losses are as learning experience and necessary cost of doing business in the market rather than personal failures. From a point of view analogy, imagine you have two identical doors. Behind one, you might gain 100. Behind the other door, you might lose 100. According to lose aversion, the feeling of losing 100 behind the second door will be much more impactful and painful than the joy of gaining 100. Behind the first, this is the depression feeling drives people to avoid the second door more intensely and then they seek the first door. From an application example, new investor quickly sells a stock that has gone up 5% in a week, fearing a pullback. Even through a fundamental analysis suggests that significant long-term growth potential. This is an example of premature selling due to loss aversion. And the next proceed with the next slide. It is with and topic is our overconfidence bias. So let's continue with the next topic is overconfidence biases. Overconfidence is a privileged cognitive biases where individuals systematically overestimate their own capabilities, knowledge, and accuracy of their forecast, particularly in complex domains like financial markets. This bias leads to investors to believe they are better at preceding market movements or select winning investments than they actually are. First one is overestimation of skills. Investors often overrate their knowledge, leading to excessive confidence in prediction. This manifests in several ways. Illusion of control, believing one has more control over random events, better than average effect, a common tendency to believe one is above average in skills and abilities, even in areas where objective evidence suggests otherwise. And the second one is excessive trading. This bias frequently results in overtrading, increasing the transaction cost and reducing net returns. Overconfident investor believes their insights are superior and that they can consistently identify mispriced asset or perfectly miss the market. This often leads to high turnover buying and selling too frequently, racking up brokerage commission spreads and taxes. Churning and extreme cases, especially with advisor executive trading primarily to generate commissions. Negative impact on returns while appearing. Active studies often show that more frequently trading driven by overconfident trends leads to worse performance and compared buy and hold strategies once transaction costs are factored in. And the last one is portfolio concentration. Tendency to concentrate investment based on biased beliefs increases risk exposures. Overconfident investor may believe they have unique insight into specific stocks or sectors, leading them to put a disproportionate large amount of their capital to a few select investment. Lack of diversification. This directly contradicts the principle of diversification, which is designed to reduce risk by spreading the investment across various assets. Last one, the amplified risk. If the those are considered investment perform poorly, the impact on overall portfolio is much more severe than its portfolio where well diversified. It initially puts all the eggs in one basket due to an unfounded belief in one superior stock picking ability. From point of view of analogy, think of overconfident bias is as someone believing they are professional race car driver of after only a few lessons. They try to race on a track. They market the market with proper training or safety measures, probably ending up a crash purely due to their inflated belief in their overdriving skills. For an application point of view, for example, who had an investor who had few successful traders during a bull market begins to believe that they are stock market genius. They even invest a large proportion of their saving into a signal volatility technology stock. Ignore diversification principle. This is driven by overconfidence bias. A day trader frequently enters an exit position convinced they can perfectly predict short-term price movements, leading to high transaction costs that encode potential profits. This behavior is systematic effective trading due to overconfidence. Let's move to the next slide. The next slide is herd behavior in markets. Herd behavior in markets refers to the tendency of individual to mimic the actions of a larger group, even if those actions their own private information or rational judgment. This phenomenon is powerful psychological biases that can lead to significant market trade, including the formation of bubbles and crashes. As the investor, abandon independent analysis in favor of following the crowd and highlight the social aspect of financial decision. First one is limitation. Investor follow actions of the word of the crowd rather than the independent analysis. Instead of conducting their own fundamental technical analysis, individuals simply observe what others are doing, as specifically do preserve a successful or smart money, and replicate those actions. This can be driven by desire to conform, a fear of missing out, FOMO, or a belief that the crowd possesses superior informations. Second is the bubble information. Mass buying drives asset prices beyond fundamental values. Herd behavior is a primary catalyst. For example, for market over as more and more investors jump into an asset class because everyone else is buying it, demand surge, pushing prices for far above the intrinsic or fundamental value. This creates a self-fulfilling philosophy for a period, attracting even more participants. For bubble, for example, it could be a dot-com bubble of the late 90s in a classic illustration where investors put their money into internet companies with low little no earnings purely because they perceive us were soaring, otherwise were getting rich. And the third one is a panic selling. Reverse herd behavior fuels sharp emotion driven market declines. The opposite side of the bubble coin is panic selling. When a market starts to decline, fear and uncertainty can spread rapidly throughout the earth. Investors who were quick to buy on the upside are equally quick to sell on the downside, often equilibrium positioning at a significant losses, irrespective of an asset underlying value. On a point of view application example, during a cryptocurrency a bull run, many new investors put their savings into various coins because they see others getting rich, driving prices to unstable levels. This is a classic example of bubble behavior leading to a bubble market. In sudden market correction, investors rush to sell their entire portfolios, even fundamentally strong companies, simply because everyone else is selling, and then downturn into panic sellings. Let's proceed with the next slide. So next topic is framing effects, anchoring and framing effects. Anchoring and framing are two distinct but powerful conflict bases that significantly influence financial. Just a second. Anchoring and framing are two distinct but powerful conflicting bases that significantly influence financial decision making. They demonstrate how our judgments can be saved not by just information itself, but by low information that the how information initially presented or proceed. Understanding the basis is crucial for investing to avoid being misled or relevant data. So here are the two choices: encouraging and frameworks. Invest anchoring investor rely heavily on the initial price of information such as past price. Even if irrelevant, anchoring basis describe the common human tendency to rely too heavy on the first piece of information offered, the anchor. When making decision on once an anchor is set, subsequent judgments are made by adjusting around it, but these adjustments are typically insufficient, leading to bias towards an initial anchor. Impact on decision making anchoring can lead to over or undervalue valuation of asset based on irrelevant historical data. Difficult to adjusting expectation even when new condition information emerges. Framing the way choices are presented influence decision causing inconsistent risk assignment. Framing presentation of adequate information in different ways can lead to different decisions even if the underlying facts remain the same. It's about the frame positive or negative gain or loss around a decision influence or perception. It was gain versus loss frame. When gain frame and options are present in terms of potential gains, people tend to be risk averse. For example, preferring a certain small gain over a chance at a larger certain gain. And the loss frame, when options are presented in terms of potential losses, people tend to be risk seeking. Example, preferring an a certain chance to avoid a loss over a certain small loss. This closely related to a loss aversion. For best example, a mutual fund might be describing an averaging at 80% success rate gain frame, a 20% failure rate, the loss frame. Through objectively the same, the success rate frame is likely to attract more investors. Similarly, a proposal to save 90% of jobs sound better than 10% of jobs will be lost. For an application example, an investor refused to sell a stock trading at a 50 rupees, convinced to undervalue because they remember it was once 150 rupees. Their anchor, they prevents from cutting losses even a fundamental version. Second, a financial product advertised at 95% chance of success, a gain frame, attracts more investor than the one advertised a 5% chance of failure, loss frame. Despite being statically identical, illustrating the framing effect. Let's put it with the next slide. The next slide is about mental accounting. Mental accounting is a cognitive bias identified by economics Richard Thaler, a Nobel economic. It is described the tendency for individual to treat money differently depending on its source of use, despite money being innately fungible, interchangeable. In essence, people create separate mental accounts for different types of funds, which can lead to irrational financial decisions that deviate from what traditional economic theory would predict. The first one is money's segregation. People mentally divide their money into different categories based on its source or intended uses. Create separate mental accounting instead of viewing all money as a single pool of fungible resources. Individual often compatible by their wealth. For example, source money earned as a bonus might be mentally separated from regular salary. For another example, a fund designated for a down payment on a house might be kept for distinct from fund for daily expenses or a discretionary spending. A vacation fund is treated differently from a retirement fund. And the second is a behavioral impact. For instance, funds preserved as a bonus might be spent more freely than regular income, significantly affecting the budgeting and investment choices.
Spending tendencies, classic example is how people might splurge a bonus on a luxury item, whereas if the same amount of money were received as a part of their regular salary, they might save or invest it. This is because the bonus account is perceived as extra or found money. Investment decisions, investor might be more willing to take higher risk when money is received as a house money. Example, profit from a previous investment compared to their initial capital. They might hold on to losing investment in more in one mental account with aggressive trading in another. Why it is matters? Mental account is important for an investor as an individual because it explains simply irrational spending and saving behaviors, help individuals understand why they are might treat different proportion of their wealth and consistency. For application examples, view an individual receive a large tech refund and spend it all over on luxury vacations. A trader, for second example, trader who makes a large profit on a stock might then use this profit to make a highly speculative investment, just as a playing with house money. Even such a high risk ventures do not align with their overall risk tolerance or financial goals. Let's proceed with the next slide. Is about the confirmation biases. Confirmation is a bias is a powerful and indicative conductive basis where individuals actively seek out, interpret, and remember information in a way that confirms their pre-existing beliefs, hypotheses, or expectations. Simultaneously, they tend to ignore, downplay, or reject information, those beliefs in the context of financial market. This bias can lead to severely flawed analysis and decision making and investor selective proceed data. The first is a selective information. Investors seek out information that supports their pre-existing view while ignoring opposing evidence. This selective behavior manifests in several waves. First one is selective exposure. Second, another will be selective interpretations. Third one will be a selective retention. And the next is the impact on analysis. This skewed information gathering leads to flawed decision making and resistant making mispricing. Ignoring red flags, investor might overlook critical warning signs about a company or fundamental values. A market impending downturn if those signs conduct their bullish or bearish conviction. Over concentration, it can reinforce overconfidence, leading to investor to double down or losing position. Concentrate the portfolio based on research or increasing risk or resistance to change. It makes difficult for investors to adapt their strategy or change their minds even when the market condition fundamentally shift, leading to being stuck or in a wrong trade. So why it is matter? Confirmation bias is profoundly impactful for investor because it distorts objective analysis, preventing a balanced view of risk and opportunities. Can lead to significant capital losses by preventing timely exit from losing position or entry into profitable ones, and determines the very purpose of due diligence through research. For an application example view, an investor who owns shares of a struggling company might only read news articles and analyst reports that offer a positive outlook, dismiss a negative financial reports, or downgraded ratings. For as a trader who is bullish on a particular sector might actively filter out negative economic data or bearish technical signals in that sector for focusing slowly on positive news or minor upward movements reaffirms their long positions. Let's proceed to the next slide, which is a recency and availability basis. The first one is the recency basis. People give this for opportunity weight to latest events impacting judgments about market directions and asset value. Vacancy bias tendency to place asset value too much importance on recent experiences or observation and to exploit those recent trends far into the future while underestimating the significance of older data. Second is a availability. Decision influenced by easily recalled or vivid information lead to overemphasis on a certain risk or opportunities. Probability refers to our tendency to rely on information that comes to mind quickly and easy when making judgment. Information that is more recent, vivid, emotional, or widely specialized is more available to our memory and thus it is our frequency. And the last one is implications leads to trend changing and reactive decisions that may discrete or long-term fundamentals, both biases and contribute to a focus on short-term and overreaction to recent events or easily recalled information rather than a disciplined analysis of a long-term fundamental or historical possibilities. Mispricing of risk, investor might overestimate a rare vivid risk like a financial crisis and underestimate more common subtitle risks like inflation aversion. For a application point of view, example, when investors sell all their stock holdings after a sharp recent market correction, a trader who avoids investing in historical safe asset, example bonds, because of one widely publicized bond default that offered recently or overestimating the systematic due to evenness of the event. Let's proceed to the next slide, which is emotion in technical trading. First, there are three trading frameworks I covered. First one is fear, greed, and consequences. Greed leads to over leveraging and holding winning trades too long past their peak. When a trade is going well, greed can tempt trades to increase their position size beyond their risk limits. For example, refusing to take profit on stock that has soared, convinced it will go to the moon, only to watch it plummet back to the original levels. Second one is a fear, often triggers a panic selling, leading to existing position at the worst possible time when the market turns against a trader or during a general market downturn. A fear can become overwhelming. For example, selling all holdings during a sharp market correction only to miss the subsequent recovery. Second is the consequences like hope, discipline leads to inconsistent results. For application example, view a trader sets a technical target for a stock, but when it reaches that level and continues to search, greed attempts them to hold on, missing the eventual pullback. Let's proceed to the next slide. Next are about the behavioral types in fundamental analysis. While fundamental analysis aims to objectively determine asset interesting value by examining economic, financial, and quantitative factors, it is by no means immune to behavioral biases, just like technical traders, fundamental analysts driven by human conjugation and emotions, and all in that have controlled the component for crucial for conducting more robust and critical. Let's revisit it to confirmation bias analysis. Selective implement data to support a precision thesis overlooking extraordinary evidence. This bias is just as prevalent in more recent fundamental analysis as a technical. Let's move. So first, the first point is sunk cost fallacy. Investor hold losing stock to avoid realizing loss, ignoring the changing fundamentals due to confirmation biases. And the second one is the brand loyalty, emotional attachment to the brands, like to my favorite brands like Nike, or they have stored the recent product from their brand. To brand distort objective evaluation, leading to poor investment decisions. Let's proceed to the next slide, which is about market bubble explained. Market bubbles are recurring phenomenon in financial history, characteristic by a rapid, unsustainable acceleration in asset prices, driven more by speculative frenzy and behavioral basis than by underlying fundamental value. Understanding the market bubble is crucial for investors to recognize the sign, protect their capital, and potential avoid losses when the bubble eventually bursts. So here the bubbles can be explained first one irrational exuberance, over optimistic investment sentiment pushing prices above intrinsic value. Second is overconfidence, belief on one ability to predict market fuel, executing risk taking. Third is the herd mentality. Mass behavior creates feedback loops, driving price instability and higher. And the third one is the historic example, which I've taken a most dot, dot-com bubble in 90s, 2028. Financial crisis, cryptocurrency surges, or demonstrate that these dynamics as the market bubbles. Let's proceed to the next slide, which is about panic selling and market crashes. The first one is trigger factors. This is a primary emotions. It can be triggered by negative news, unexpected economic data, geopolitical events, or even just a significant initial drop in prices. The fear of losing capital becomes more overwhelming, overriding long-term investment goals. Second was the emotional overrides. Rational analysis frequently abandoned during a downturn. Thus, during a period of panic selling, the logical data-driven approach typically associated with sound financial analysis is often completely overridden by raw emotions. Ignoring fundamental values, investor may sell fundamentally strong companies that are now undervalued simply because their price is falling with the overall market. The third one is consequences. Panic, excessive volatility, and undermines investor confidence. Increased volatility, the rapid under coordinated selling causes extreme price swings, capping down, making market conditions highly unpredictable. Undermines undermines our confidence. Market crash further damages investor confidence, making them to reluctant to re-enter the market even after prices have stabilized or rebounded. This reluctance can prolong bear markets. From an example of applicant example during the COVID-19 conducted market, the crash in market 2020, many investors panic sold their entire portfolios driven by fear and uncertainty, only to miss the subsequent rapid market recovery in the following months. In 200 financial crisis, even financial sound companies saw their stock prices plummet due to widespread panic selling and complete loss of investor confidence, despite strong balance sheet in some cases. Let's proceed with the next slide, which is combining fundamental analysis and technical analysis with psychology. While fundamental analysis focuses on intrinsic value, technical analysis focuses on price patterns and candlestick. Both are executed by human beings, susceptible to biases and emotion, integrating the insight from behavioral finance psychology with traditional F1 technique creates a more holistic, robust and realistic approach to financial decision making. The first one is the behavior integration. The first one is behavioral integration. Behavior psychological provides a why behind the market movements and individual decision making, helping to understand collective sentiment, identifying convective bias your own and others, and anticipate irrational market behavior. For example, herd mentality, overconfidence, panic selling. Incorporated psychological helps detect emotional biases, influencing entering and exit points, bridging the gap between analytical strategy and human behaviors. Second is a enhanced risk control. Fundamental analysis informed by evidence. A strong company might be temporarily undervalued due to market fear or lack of attention. Behavioral insight can be a help of view investor potential accumulate conversely irrational. A fundamentally weak company might be too overvalued due to irrational overbalance and hard buying in a bubble. Technical analysis is guided by a behavioral context. The technical patterns can be amplified or negated by implementing market psychology. A strong breakout on chart, if driven by pure FOMO and overconfidence, might be unsustainable. For example, a bearish divergence on RSI might be a stronger sell signal if combined with extreme overconfidence and among a real investor in the asset. For application point of view example, an investor identifies a fundamental strong company that has seen its stock price fallen significantly due to panic selling during a market correction. Using technical analysis that identify a strong support level and bullish reversal candlestick pattern, confirming a good entry point when the market's irrational fear subsidies. The next slide is tools to counter behavioral biases. This slide introduces the concept of tools designed to help investor to make this slide introduces the concept of 12 tools to design to help investor make more rational decision by counteracting common psychological pitfalls. Real world example, imagine an investor who tends to panic selling during a market downturn. This is the behavioral biases loss aversion. First one is the trading trade journaling. Trading journaling involves systematically recording our trades and reflecting on the decision made. The practice helps in developing self-awareness regarding your trading habits and emotional responses. For example, would be an investor keeps a journal in noting each trade, the reason for entering and expected outcome, the actual count and their emotional state during the process. Over time, they might notice a pattern of making impulsive decision when the market is highly volatile. Third one is a rule and checklist. The slide highlights the importance of establishing predefined criteria and checklist to prevent impulsive action. This can act as a structured framework for decision making, ensuring consistency and discipline. And the fourth one is a behavioral dashboard. Behavioral dashboard are visual tools that monitor emotional reads metrics in real time. They can help investors in identifying where their emotional might be influencing their decisions. For example, a trading platform will display a fear index based on market sentiment or personal dashboard might track how often an investor deviates from their preset rules. If the dashboard shows high emotional risk, the investor know to pause before making a decision. Next to the next slide. Let's take a 2 minutes break. So the next slide is a real world application. Behavioral finance can significant implication across various areas of the financial world. First one is the retail investing. Awareness of behavioral biases can significantly improve individual portfolio decisions and discipline for retail investors. For example, retail investor who understand holding biases following the crowd might resist buying into a speculative bubble even if everyone else is doing so. Second is the trading desk. Professional traders can use the knowledge to control their emotional impulsive trading to enhance performance. For example, a professional day trader might recognize when they are experiencing overconfidence bias offer a string of successful trades and thus reduce the position size to avoid taking excessive risk. The last point is about robo advisor and advisors. Integrating behavioral finance principle helps refine client advice and improve automated investment strategies offered by robo advisors and human advisors. For example, a financial advisor might tailor investment recommendation based on a client specific behavioral basis. Example, suggesting a more diverse portfolio for a client prone to chasing returns. Let's to the next slide. Proceed with the next. Key takeaways and job relevance. First one is understanding behavioral finance, providing crucial skills for financial professionals. First one is a risk management. Comprehending biases improves risk and decision-making frameworks. Second is a client advisory. Emotional intelligence gained through understanding behavioral finance fosters stronger client relationship and build trust. The last one is a strategic thinking. Behavioral insights are initial for navigating complex markets, improve overall outcomes. Behavioral finance bridging theory and practice. Behavioral finance links according to theory to actual market behavior. It equips financial analysts and professionals to effectively interpret investor psychology. For a real world example, a portfolio manager who understands the anchoring biases over relying on the first piece of information will actively seek out of diverse opinions and data points before making investment decisions rather than sticking to their initial assessment. Let's move the next slide. The first our topic is next topic behavioral finance bridging theory and practice. So first one is the implied insights. Behavioral finance combines psychology with traditional finance to create better decision making frameworks. For real world example, instead of just looking at financial ratio analyst use applied behavior finance might also consider how news, sentiment, or social media trends could influence. Next one is the practical value. The practical application of behavioral finance enhances risk management, client advising, and trading performance. For a real world example, by identifying a client's disposition effect, tendency to sell winners too early and hold losers too long. And the next one is initial skills. Behavioral awareness is an initial skills for modern finance careers. For example, recruiters in investing banking or asset management increasingly look for candidates who demonstrates an understanding of human psychology and impacts to financial market. So the next topic is risk management and financial analysis. This slide introduces the critical role of the risk management financial analysis, which is to protect investment and improve decision making. For example, company finance department use risk management to assess potential impact of a new product launch to their overall profitability and cash flow. Understanding and managing risk is initial final analysis to protect fundamental and improve decision making. This presentation explores how identify measures and build various types of financial risks, whether you are analyzing portfolios or corporate finance, or mastering risk management and touch ensures compliance with regulatory standards. Let's proceed with the next slide. So next is about topic is what is a financial risk? Financial risk is defined as a
It's the possibility of loss of variability in returns inherent with all financial decisions. It represents uncertainty in outcomes and affects both investor and companies. Recognizing its presence is crucial for effective and analysis and strategy development, highlighting the needs of comprehensive risk management frameworks. The first one is a loss potential. Risk is a chance that returns will deviate negatively. Second is the ambiguity. Give every financial decision involves some form of risk. For a real world example, when you invest in a stock, there is a financial risk that is price will go down, leading to a loss. This uncertainty is the instance of financial risk. Let's move the next slide, which is about types of financial risk, which I have covered. First one, the market risk, credit risk, liquidity risk, operational risk, and legal and regulatory risk. First one is the market risk, exposure to losses from market prices, change in market price such as stocks, interest rates. For example, the value of a stock portfolio decreasing due to general market downturn. Second is the credit risk, the possibility that a borrower will fail to meet their obligation inspecting leaders. For example, in real world, a company defaulting on its bonds, causing bondholders to lose their investment. The third one is liquidity risk, the risk of not being able to buy or sell asset quickly without loss. The risk of not able to buy or sell asset without incurring a loss. For example, owning a rare piece of art that is difficult to sell quickly at a rare fair price if you need urgent cash. And the fourth one is the operational risk. Losses due to inadequate or failure to internal process, people or systems. For example, a cyber security breach leading to financial losses for a company. And the last one is a legal regulatory risk. The potential for legal penalties or compliance failure due to changing in laws of a company. For example, a pharmaceutical company facing a large fine because it failed to comply with the new drug testing regulations. Let's move to the next slide. Why risk management matters. Risk management is crucial for several reasons. First one, the protect capital. It minimizes losses through proactive identification and control. Enhances decision quality. It improve investment and operating choices by confident risk level, ensures compliance and trust. It helps to meet regulatory requirements. For example, a startup implement robust risk management. It protect its initial seed capital, make informed decision about product development, and build trust with early investor by demonstrating financial prudence. Let's move to the next slide, which is risk in investment decision making. The risk plays a fundamental role in investment decision. First one, the risk versus return trade-off. Generally, higher returns require accepting greater risk. Second one is the assess risk ability. Investors choose assets that align with personal tolerance for risk. The third one is a diverse portfolio. Uses combination of assets has manage overall risk exposures like a hybrid mutual fund plan. For example, a young investor with higher risk ability might invest in highly growth stocks, while an older investor nearing retirement might prefer a more conservative portfolio with a higher allocation to bonds. Let's move to the next slide, which is volatility as a risk indicator. Volatility is a key indicator of a risk. First one is standard deviation, quantifies the variability in asset returns over a time. A higher standard deviation means more volatility and thus more risk. Quantifiability in asset returns over a time. Second is the volatility index VIX, measures market expectations near term volatility, often called the fear index. High volatility. Second, the third one is the higher volatility, signals greater uncertainty and potential risk. For example, if a
stock has a higher standard deviation. Its price tends to swing widely, indicating higher risk. A sudden spike in the VIX might signal increased market certainty and potential downturn. Let's move to the next slide. The topic is beta and systematic risk. Beta is measured of systematic risk. Beta, first one is beta, the definition measures the sensitivity of a stock returns to overall market movements. If beta is less than 1, indicate the stock is more volatile than the market, suggesting higher systematic risk. Third one, the portfolio use. Beta helps in constructing portfolios that align with desired market risk exposure. For a real world example, a tech stock with a beta of 1.5 is expected to move 1.5 times as much over the market. If the market goes up 10%, the stock is expected to go up 15%. If the market goes down 10%, the stock is expected to go down 15%. Let's proceed to the next slide, which is at VAR, which is value at risk. Value at risk is widely used risk management metric. For a definition, I estimate a potential loss over a specific time frame at a given confidence level. Second was the application. Financial institutions use VAR to set risk limits and determine capital requirements. And the third one is the methods, includes historical simulation, variance coefficients, and Monte Carlo approaches. For a example, real world example, a bank might calculate that it has 99% wire of 10 rupees, $10 million over 1 day, meaning there is a 1% chance it could lose more than 10 million in a single day. Let's move to the next slide, which is stop loss and exit strategies. This slide discusses methods to limit losses and manage risk in trading. The first one is stop loss mechanism, an automatic order to sell an asset when its price reaches a predetermined level helps to limit potential losses. Second one is the exit strategy importance. Having a planned exit strategy prevents emotional decision making and protects against significant losses, drawdowns in volatile markets. Third one is the risk control. These strategies are initial for maintaining portfolio discipline and safeguarding investment capital. For a real world example, an investor buys a stock for 100 rupees and set a stop loss order at 90 rupees. If the stock price drops to 90 rupees, it automatically sells, preventing further losses even if the investor is busy for emotional. It would be a vice versa for a buying, for a target profit looking. Let's move to the next slide. Diversification to reduce risk. Diversification to reduce risk is core principle of risk for management in investing. First one is a concept that involves spreading investment across various asset classes to spread risk, often potential losses in one area with gains in other, like spreading a portfolio in various sectors like tech sectors, energy sectors, and many more other sectors. Second is a correlation principle. The key is to choose assets that have low or negative correlation, meaning that they do not tend to move in the same direction at the same time. This helps to reduce the overall risk exposure of the portfolio. And third one is the benefit. Effective diversification can improve these adjusted returns, meaning you get more returns for the amount of risk you take, and it helps stabilize overall investment outcomes. That version to reduce a real world example, instead of putting all your money into single tech stock, you can invest in a mix of stock, bonds, and real estate. If the tech sector declines, your investment in bonds or real estate might hold a steady or even increase, buffering your overall portfolio. Let's proceed to the next slide. Asset allocation and aligning with restoration. What is asset allocation? Allocation is strategic approach to investing. It is the process of deciding how to divide your investment portfolio among different asset classes like stocks, bonds, and cash to achieve a balance between risk and reward that suits your individual comfort level with the risk. So the next point is consecutive versus aggressive. Consecutive portfolio, these are designed for investors with a lower tolerance for risk. They typically favor stable, less volatile assets for such as bonds and cash, prioritizing capital preservation over a high growth. Aggressive portfolio, these are for investors willing to take one more risk for potential higher returns. They emphasize the asset with greater growth potential like stocks and alternative investment which also come with increased risk. Let's move to the next slide, which is risk ratio, key metrics for evaluations. This slide introduces quantitative measure used to evaluate risk and returns. First one, the Sharpe ratio. This ratio measurement the risk adjusted return of the investment. It calculates how much excess return above a risk-free rate an investment generates for each unit of a total volatility risk. A higher Sharpe ratio is better. Second is a tenure ratio, similar to Sharpe ratio, but it evaluates returns relative to systematic risk before a market risk, specifically using beta. It is used for diverse portfolios. Third one is Sotonio ratio. The ratio is variation of the Sharpe ratio, but specifically focus on downside risk. It penalizes only negative volatility, unwanted price declines, making it particularly useful for investors concerned about losses. For example, if a fund A has a Sharpe ratio 1:2 and fund B has a Sharpe ratio of 0.8, fund A is providing more return per unit of risk taken, making it potentially better investment from a risk-adjusted perspective. Let's move to the next slide. Hedging versus derivatives to it manage risk. Derivatives are financial contracts which values derived from underlying asset used to manage risk. First one is options. These are contracts that give the buyer but not the obligation to buy or sell an underlying asset at a specific price, strike price, on or before a certain date. They can be used to protect against price drops, buying put options to gain from price increasing, buying call options. Second one is the futures. These are standardized agreements to buy or sell specific asset at predetermined price on a future date. These are used to look in prices, reducing certainty for producers and consumers. Third one, the swap. These are custom agreements between two parties to exchange cash flows or asset over a period. These are commonly used in hedge against interest rate free of currency exposure. For example, an airline expect to buy a large amount of jet fuel in 6 months. To hedge against the potential increase in fuel prices, they could buy a future contract to look in the price today, reducing the exposure to market fluctuations. Let's move to the next slide. With a financial analysis for risk detection. Financial analysis plays a crucial role in identifying potential risks within a company or investment. First one is the red flag. Certain indicators warn of potential financial details. These include a weak or declining earnings, a high debt amount or of uncollectible debts, bad debts, and unstable or negative cash flows. Second one is the important ratios. Several financial ratios are particularly useful for risk detection. First, is debt to equity ratios, interest coverage ratio, Altman's ratio. Debt to equity ratio measures the proportion of debt and financial relative to equity. A high ratio can indicate a significant financial risk. Second was the interest coverage ratio indicates a company ability to pay interest on its outstanding debt. A low ratio suggests difficulty meeting interest obligation. Altman's Z score a formula that predicts the probability of a company going bankrupt. Third one is the purpose. The main goal of using this tool is to identify financial abilities to earn early, on which helps to mitigate investment risk or prevent credit defaults. Let's move to the next slide. Next one, technical analysis for risk timing. First one, reversal zone. Technical helps to detect areas where a price trend might be about to change direction, reverse. Identifying the zones can help to trader exit losing positions. Second, overbought level indicators like the relative indicator RSI helps signal when asset price helps to resent too much overbought or over fallen too much oversold. These warnings are invested to avoid poor entry points such as buying at a peak or selling at a bottom. Third, with the timing trade entries. By using technical analysis, patterns and signal traders can minimize the risk of unfavorable market moves by entering the trades at opportune moments. For example, traders see the stock price reaching an overbought level of the RSI indicator approaching a strong resistance level or reversal zone. This signal of a high risk of price falling, so traders decide to avoid buying the stock at that moment. Let's proceed to the next slide. Scenario sensitivity analysis risk modeling. These are powerful techniques used in financial modeling to understand and manage risk. First one is scenario analysis. This involves in testing the outcomes of financial model under different hypothetical condition or scenario to evaluate risk impact. These scenarios can range from optimistic to pessimistic, helping to evaluate the impact of various risk factors. Second is a sensitive analysis. This technique assesses how much the overall valuation or forecast changes when individual inputs or assumptions in a model are altered. It helps identify which variables have the biggest impact on the outcome. The third one is the application. Both analyses are widely used in discounted cash flow DCF method models and financial planning to traces, test, assumption, and understanding the range of possible outcomes. Let's put in the next slide. So the next topic is common risk management and mistakes. Even with sophisticated tools and a theoretical understanding of risk, investors and financial professionals frequently fail prey to common pitfalls during risk management. These mistakes are often driven by consecutive basis or lack of discipline. The first one is ignoring tail risk. Description there involves falling to a considered rare but so even that if they occur or have a massive highly negative impact. These are called often black swan events like the 200 financial crisis or in the initial market shock of the COVID-19 pandemic. Next point is over leveraging. This mistake involves using extreme borrowed capital leverage to amplify the potential returns of an investment. While leverage can boost gains, it equally amplifies losses, causing rapid portfolio deteriorations, am- amplified losses, margin calls, consequences. The third one is overconfidence in models. The pitfall involves blind reliance in our imperfect models like VAR, black sources. While powerful, these models are based on assumptions about market behavior and historical data, which not may not really hold true. Garbage in garbage out models are only as good as their inputs and underlying assumptions. If assumptions are flawed or data incomplete, outcome will be the misleading. For analogy point of view, imagine building a house, ignoring tail risk is like not checking the foundation of an earthquake existent in seismic zone. For a point of view, over-legging is like building too many floors without reinforcing the structure, making it too heavy and unstable. Overconfidence in models is like trusting in a blueprint implicitly without considering actual terrain or weather patterns. For application examples, a hedge fund can high leverage on a seemingly safe bond strategy focuses on expected liquidity crisis causes bond prices to implement due to over-leveraging and ignoring tail risk. Let's move to the next slide, which is risk management tools and career applications. This slide highlights practical tools and importance of a risk management skills in careers. First one is analytical tools, Excel dashboards used for real-time monitoring for risk metrics. Second point is Monte Carlo simulation, such as computer technique that models probable outcomes by running many simulations using random variables used for probabilistic forecasting. Third one is specialized risk platforms such as Bloomberg terminals and Python frameworks, libraries used for advanced risk modeling and analysis. And the second one is career importance. The risk management skills are highly valued in various financial skills are highly valued in various financial sectors, including banks, investment firms, fintech companies pursuing individual internships, jobs in the area helps to individual develop strong analytical abilities and strategic thinking. Let's know the example for real a financial analyst of using Python to build a Monte Carlo simulation model to predict the potential range of outcomes of for a new investment, helping understand the associated risk. And the last slide of this session, where we summary and key takeaway for this session will be a risk in inevitable. All financial activities involve risks such as hedges and on managing effectively rather than avoiding it entirely. Balance reward and protecting strong financial involves a dual approach seeking potential gains while implementing strategies to defend against downside losses. Continuous learning, these financial markets are constantly evolving tools, understanding market signal, continually refining risk metrics is initial for informed decision making. For real world example, a successful long-term investor understand that market downturns are inevitable. They do not try to avoid all risks, but instead balance their desire for growth with protective strategies like diversifications. These also continue to learn about new market trends and risk management and techniques to adapt their strategy. So this session has been over. So any event doubts or any questions you can ask our regulating chats.